Richard or Derek, you want to maybe start us off until Jerry can get back online?
Yeah, no problem. So, look, this is Clubhouse, of course, Jerry's Clubhouse, and what we do each week is we choose some topics about classic trend following and discuss them. So, look, in Jerry's absence, he's obviously having some issues with his audio. We might get the ball rolling. So, has anyone got any particular topics they'd like to discuss today? One of the things I noticed this week was when I looked at Paul Mulvaney's results for this month. He's or last month, he's pulled another 9% return, which really has rocketed him up with these last few months. Consecutive returns have been quite stunning, and it just made me think that. Um, with our particular method, our trend following method, we do leave ourselves open for infinite potential. So, what always grabs me is that I think to myself, well, perhaps what we've seen over the last 10 years has been pretty tame. And because of our unlimited possible upside, we might get these fantastic returns that we've never dreamt were possible with our method. Derek, do you have anything you'd like to raise today?
Sure, and I will use the classic. Let's look at some tweets. So it does have to do with crypto, which is not exactly our normal asset class, but it does have to do with trend following. So Drew Su, which is someone who's here in Singapore who runs Three Arrows Capital, was talking about how people trade altcoins and specifically looking at a strategy that sells half when you've made 100% or one that sells half when you're 50% down. And I find that very interesting because, I replied, it sounds like you better cut your losers short and let your winners run. I find this alternative coins, I won't use their derogatory name, I guess, quite an interesting space to discuss trend following because of the high amounts of volatility, the high amounts of retail participation. Basically, it's 100% retail, and kind of the lack of these pricing models that allow people to how do you say it, like mean reversion trade. So because of these characteristics, I find it's funny that on YouTube or Twitter or whenever you try to look up these things, there's always people saying like, okay, they can go up, to the moon or whatever. But most of the strategies I found are about like setting profit targets, which is counterintuitive considering you're probably trading the thing that has the largest potential to trend. I mean, in the fact of hundreds of percents per year or crash to zero. And that zero barrier or absorbing barrier, as Richard would say, is quite an interesting phenomenon because now you have this like asset class that has massive ergodicity. It's almost like a call option because if you know it can go to zero and you only risk what you can, lose or whatever, then it's just a call option. But then people are mismanaging this type of position instead of using something like a trailing stop.
Yes, look, I've often thought about Perry Kaufman's overview of how he views these new markets, these new emerging markets, and we're talking about these altcoins as a new market, and I just wonder whether the participant mix in these markets, whilst they might be using profit targets, or these retail traders might be using profit targets, I'm just wondering if the nature of their trading actually engenders a degree of trend following bias into these infant markets. And like when I see the performance of Bitcoin and these altcoins, we see these fantastic trending opportunities. I see this a lot in any new market that gets established. And where I see mean reversion start really taking hold is more in the mature markets, and we get a lot of noise, we get a lot of mean reversion, and I'm just wondering whether it's the nature of the participant mix when it gets quite diversified, lots of different traders doing their different behaviors, resulting in this sort of complex patterns in the market that are not strictly trend following. But in the absence of that plethora of different behaviors, there tends to sort of almost be a trending bias in these infant markets. So yeah, look, it's interesting, Derek, and I'm wondering about. I know the two Moritzes are very interested in these cryptocurrencies as well as NFTs, and I'm wondering if these are the new trending opportunities within our universe.
I'm familiar with the Perry Kaufman's efficiency ratio, if that's what you're referring to.
Yeah.
And actually, I had used that in a study that I had done at the previous firm I had worked at because, again, I was in the mainland China and I was evaluating, trying to compare and see, like, without back testing because data was limited, if certain things would work that I could port over from working in the US. And I did find that they were less efficient in this way, which meant in the Kaufman's efficiency ratio, basically, like they go up more linearly than there is volatility. I don't remember the exact formula, but it's some ratio of like it wants to go basically from the bottom left to the upper right, and like that path that it takes or how long it takes, is kind of like a decreasing, then it's increasing signal to noise ratio. Um, I I did find that in China. I had found that decreasing as like my work there went on, and more participants from the States, from Europe, began to enter the market, and it became less trending. And for me, I always think about the first principles, or why this should be the case. And I do believe it comes down to participation. Um, and I can give the Chinese version, and then I'll give the altcoins version, because I mean this is true for all commodities, and why commodities have a potential to trend, say, more than um, an equity or something. I mean, I'm making a generalization there, but when you have participants that have a economic incentive that is not in the system, and when I'm talking about the system, I'm specifically meaning the futures market that we as trend followers are trading, they are willing to take a loss or like not necessarily make money on that position, and that allows them to do certain things that you would think would be, quote, illogical if they were purely trying to make profit from the market. So you are able to extract that, and they will continue to put on large continuous positions to hedge their cash flow, which creates all sorts of exploitable distortions in price. One of them being trend, another one being carry, like contango, carry, and backwardation, things like that, because you have people actually making money in as a commercial. In the altcoin space, you have the meme-ness. And I will say that the meme-ness began in cryptos, trickled into Robinhood, and then has made a round turn. And the issue with that is, or not issue it, but the momentumness is because they want to be seen on social media taking these positions. And you will get ridiculed if you don't hold and if you don't add on. And people will congratulate you on losing, I mean, life-changing amounts of money, from the hundreds of thousands of dollars to millions of dollars. I mean, on this recent Squid Game thing, I saw the video. A guy lost $1.8 million in about 60 seconds. And people will congratulate you. You'll get famous on YouTube, and that's like a whole different world. And again, you get to put that human emotional bias into the markets on a place where, because it's small, because it's unregulated, there is a barrier to entry for larger firms to come in, or they don't want to touch it for regulatory unclarity, or however you want to say. And that means the people who are doing the mean reversion trading don't necessarily exist as much. Now, in the crypto space, you have Jump, you have Citadel, you have DRW, you have a couple of other large big players, but mostly they're providing liquidity, and there's a bit of um, a prop angle to that. But mostly, like, they like to provide liquidity and do OTC. At least that's my discussions with some of my contacts at these firms. So if you think about the makeup and the composite, the makeup of the participants and the composition of their strategies, it's totally different than if you think about someone who's trading equities. And I put equities as the example there because you have statistical arbitrage, which you begin in equities. These things are of the same sector or they're integrated. We should be able to mean revert them, even though they're completely different companies. And that depresses volatility. It creates all these other issues. You know, you don't have massive passive in the game. Okay, now you do with the futures ETF. That has yet to be seen on how that's going to flow through, but not on these smaller coins. So I find that those types of hurdles, we understand why. There's reasons why, and then that can help me inform why that efficiency ratio should be higher. I mean, there's other measures to use that, but I think it's well known. Does that help clear up things?
Yeah, it certainly does. And look, the way, if I could imagine a market as being an intelligent market, ultimately the market is a manifestation of everyone's opinion of what price should be. So in the early stages of a market where there are a few players with a degree of significant uncertainty with what they're dealing with, I can see that behavioral bias might significantly influence the price in that immature market. But as more and more players, the more institutional players start entering that market, there's a firmer concept of what price should be. So there are the fundamental analysts coming in, all of these different behaviors coming in, which are more trying to sort of confirm what the level of price should be from more quantitative bases, as opposed to just an opinion or a behavioral opinion, that price probably does tend to settle down a lot. And it's just interesting the way Perry looks at his efficiency to noise ratio, or his efficiency ratio with his signal to noise ratio, where he is simply looking at a linear, what degree of linear move do we have in relation to its horizontal time, with a strong sort of linear upward move and a strong linear downward move over a short time interval would be classified as a strong signal. But if we get a lot of horizontal movement in that price, and there's a slow wandering up or a slow wandering down, that transmutes into a lower signal to noise ratio. So it's an interesting concept, but there's definitely appears at least to be something in the life cycle of a market, how it matures over the time, and there certainly seems to be more preferential times than others from a trend following perspective to take advantage of perhaps that behavioral bias that tends to influence the early stages of that market. Just want to check if Jerry's okay.
Yeah. From my
Yeah, I had to
Oh, go on,
reboot my
Jerry.
phone. Never had to do that before. Can you hear me?
Yes.
Yeah, yep.
Okay, good. So sorry about all that. I'm not sure. I had a big long monologue that now doesn't like it was worth it, but I don't know if you heard that as well. But
No,
Didn't
go
heard
for it,
any of
Jerry.
it.
We were sort of taking up the slack while you were away, and we were hoping that we're keeping people occupied. But you've probably got a better start to this whole thing than we do.
oh no, I mean I could see that Derek had his mic unmuted, but I kept nothing was coming through. I never had to reboot my phone like this before. Anyways, I was just saying we had a good time yesterday on Derek's club, and then we kept it going for a bit longer, and that was fun. And I just brought up this one idea that I had that many years ago, I building off this idea of not not paying too much attention to the open trade profits and letting those things fluctuate as much as I humanly was possible. I came up with this idea to another way to show the performance of our trend following fund. And that was something we called a closed equity performance table, which simply just did not show any of the open trade profits. And we just ignored it totally. And most of all of the time, the open trades were net profitable. And so we were just withholding good news and just showing our P&L in terms of the small losses we had taken during the month or the closed out profits, which, we could have a losing month in total, but a winning month on this closed equity performance table and vice versa. So we thought that was so great, but no one really liked it except us. And we kind of got tired of it, and we were paying the accountants extra money. So we kind of stopped doing it, which is a mistake. We should have kept it going. And I suppose we could go back and try to recreate it, but it was just a way to possibly get people to really focus on um, the real profits that we had actually booked and discount totally the ups and downs. So we we certainly showed a smaller performance than our peers during the good times, but we also protected them from the volatility that no one really likes. And I thought that this whole idea was somewhat similar uh, to private equity in that they don't mark to market the open trades daily like we have to do, and I think the clients kind of prefer that. I read a lot of articles about how the clients really actually don't mind not seeing the performance. They like to sit back and hope that everything's going well. And so anyways, I just thought that was kind of an interesting situation where all this money is going into private equity with their um, um, and hoping that things turn out well, and no one seems to bother with smoothing out the returns or all the things that we concern ourselves with sometimes.
Yeah, look, I do frequently use simply my realized balance or plot my realized balance as an equity curve to totally eliminate my desire to sort of look at these unrealized profits which inevitably with positive skew sit above that realized balance line. But what I do find when I look at the equity curve signature of the realized balance or the closed equity is that you can really dramatically see the influences of outliers with these massive step ups in the equity curve. So if you imagine when you're trading these outliers, of course they're sitting in unrealized equity while they slowly sort of deliver more and more sort of profit, but you don't see that with the realized balance line. But what you do see is when those trades close, or ultimately when those outliers ultimately cease, you get this massive vertical step up in your equity curve. And what I always do is I compare that vertical step up with the sequential small drawdowns that slowly build. So there's two profiles. There's one of the linear, slow, progressive drawdown in the equity curve with the realized balance. And there is one with these massive nonlinear step ups. And that really hammers home to me this principle of path dependence, where if we can deliver these uncompounded return streams that have this beneficial, positive asymmetry in them, as soon as you apply a compounding technique as an overlay to that, you get this massive acceleration in your wealth. Of course, the reverse is true for, say, a convergence signature where you've got negative skew, many small wins, so you get this linear lift in your realized balance. But when you get to these drawdowns, in the realized balance world, you see these massive nonlinear downturns, and that's where you see this whole principle of non-ergodic paths or path dependence coming in, which truly hammers home this principle that if you want to take advantage of this principle of compounding, there definitely is a superior geometry that you can achieve by trading positively skewed systems. The method that we deploy, I personally think that this whole process we've been talking about, where we're hunting for outliers, we're using diversification to get as many as we can. All of those things are the fundamental ingredients to produce this positive asymmetry and this unrealized equity curve. But then when we overlay this compounding on top of it, bang! It just takes off to the roof. And that's where I think, my effort is placed towards achieving this best geometry, if that makes sense.
No, it does. It makes perfect sense. And I totally get it now, this compounding. And I thought that podcast you did with Niels last weekend was just the best ever. I mean, um, Oleg is like the president of my fan club. And I'm definitely want to nominate myself to be the president of yours because I really enjoyed all of that. And I'm still waiting for YouTube to put out their version so I can get the transcript and copy paste and steal all your ideas and put quotes around it. But even if you put quotes around it, people probably still think it's coming from me, no matter how much I try to accurately attribute it to you. But I thought that thing was just so amazing. And left me just with one conclusion, although I've got to go back and absorb some more of it, of course. But it left me with this one conclusion that um, all of these systems are not created equal. And we just have the best. And the more you can get this asymmetry and take advantage of this, the more you're going to be able to compound. And then it was kind of baffling also because the conversation started going towards, well, buy and hold and adding CTAs and trend following to, and I'm just like, the rest, when is the rest of the world will one of these days grasp onto this, that it makes no sense that stocks are the center of the universe, of a portfolio universe. And for God's sakes, if you're going to make it that way for some reason, that stocks have this inherent superior trending characteristic above every other market, which there's no evidence for that, then if you've got to make stocks the center of your world, then how about trend following the stocks as well? What do you think?
Yeah, definitely, Jerry. Interestingly, I came away from that podcast a bit exhausted, and I thought to myself, I didn't do a really good job. There was lots of almost confusion in there with some of the things I said. So at least I hope you did take something away from it. But yeah, I certainly came away from there a bit disappointed. When you do one of these podcasts and you think to yourself when you listen to them the next few days, oh God, if only I'd said this or if only I'd said that. I certainly came away from that one thinking of that.
Hello to everyone. By the way, I often said, not once, a few times, that one of the best description of trend following, and I think for investors and for all people, is non-linearity from Richard. And I have said this a lot of times, that +1, -1, +1, -1, +20. It's really great, and I think very often about this because this definition is very, very great definition of transforming process.
Many thanks, Oleg. Yeah, I definitely think that way as well. But I'm glad you appreciated it. I certainly think that way.
Yeah, the podcast was great, bringing the ergodicity and compounding themes to the trend following language. I'd like to not to second but to third big compliments, Richard. And you were talking just now about compounding. What would be what do you think would be a reasonable rule to apply to that? I gravitate toward um, updating the trade level based on closed equity, but I'm not sure if that would be reasonable enough. Perhaps a time span, I don't know, update on closed equity every quarter, or I don't know. What do you guys think?
Look, the way I view it is theoretically, if we wanted to make the most money, we'd compound on a trade by trade basis. When the trade closed, we'd update our realized balance and we compound that way. However, what I find is that if you adopt that fairly aggressive compounding treatment over, say, a 20 or 30-year time frame, you find that as your equity builds, and because this compounding is so powerful, we're talking about, you might be starting with a nominal sum of $1 million, say, in your back test. But, after the 10th year, you're sort of dealing with, 25 million, 30 million under compounding. And it's this exponential function that just lifts it. So there comes a point in time where you've got so much equity that the impact of the volatility expressed in that leverage from the compounding effect probably damages the psyche, I say, even though probably theoretically it's the optimal way to deal with compounding. It just doesn't sit with me because as my money builds, I do get more defensive. I naturally get more defensive in trying to preserve that capital. So I step back and I say, well, look, I will only compound maybe on a month by month basis. So I determine my realized balance at the commencement of the month, let a whole month run where I'm trading the same dollar risk exposure for each of my my systems. And then at the end of that month, I'll then say, well, what's my realized balance now? And then take the next month and do the same thing. So I'm only compounding monthly, but theoretically, you'd probably be wanting to do it. You want to be doing it, potentially daily. And this is where you can start using, the Kelly criteria or whatever, because I do note that a lot of people believe that that's a path-dependent ratio. I sort of have issues with that because I actually don't think Kelly is a path-dependent ratio because it is based on variables that assume constancy or over a particular time period. So when you adopt the Kelly ratio, of course, if there was this constant regime within which you did do those calculations, you would be your betting size would be geometrically optimal. However, I'm not so sure about the Kelly criterion. It's exceptionally aggressive, and most people do say, well, look, maybe go down to half Kelly. But I tend to think, well, look, forget that. I don't have implicit faith in it, but what I will do is I will deploy a simpler method of compounding, and I just tone it down. I don't know
Oh,
what
sorry.
Jerry
I
thinks.
think I lost. I don't. I think I lost you on Kelly. You mean use Kelly to size the position, right? Not about the timing.
Look, I wouldn't even use Kelly. I'm a bit suspect about the Kelly criterion. Maybe Derek knows more about it, or some of the other guys know more about it. But I'd actually appreciate your opinions on the Kelly. But I personally don't use Kelly. I use just a fixed fractional basis, which I do each month. That's simple for me, and I can manage it. That's what I use. But I'd be interested to hear what Jerry and what Derek think about that.
Do you true up your positions on a monthly basis? Like if you make 1% this month, do you make all your old positions 1% larger or smaller?
No, I don't do any truing up. So once I take my trade entry, that's it for that position, and I let that go. This is where I believe personally, from my perspective, that any tampering to a trade that's currently in process is a kind of profit massaging method or a method to potentially smooth the returns, and therefore I opt not to do that. So there's no truing up of my positions. All I do is I say for any new positions each month, this is the new trade risk I apply to that position.
Yeah, I don't think there's any question that that's correct. I've done it both ways, and I don't think I think I've said before in 2008, around that period, so many crazy things were happening. We started seeing things we had never seen before, and I think this true up sounds something that I think we did. I know we did it on January the 1st, let's say, and then it didn't work. It was like part of our problem in that one period. So I think that when you have a problem with your logic, and it's not going to be subject, it might not be caught in the back test, and then all of a sudden when it screws you up, you're like, oh crap, yeah, that's I'm not going to do that any longer. It's obviously wrong. I should not do things like that. And anyways, that's just a little FYI that it could take a long time for you to be punished and in a long time for you to be rewarded. You're doing the right thing all the time and it just doesn't look like it. So this is one of the problems, especially with long-term trend following. The problem, I think I understand Kelly, and I think the problem I have with it is not that I have a problem with Kelly. I have a problem with our systems. and how reliable that we should assume they're going to be. And then and if you do this back test, I think, and you have this experience post back test, then I mean, it looks really good. And so should we assume that that's going to go forward in the future in that particular way, or should we be fearful that bad things can happen and that we'll see things we've never seen before, as far as our average win, our average loss, our win percentage, plugging those numbers in as if they're the gospel? No one pays more attention to them than me, but I'm going to bet my life on them. I'm ready for bad things I've never seen before to happen with my system, with its performance. And so cutting it back a bit and getting ready and implementing from the get-go a conservative money management um, that I use, which is the closed equity, but I only update it when I have small open equity. So I haven't updated my equity in a while because my open trade equity has been very large. And so that is overly conservative, granted, but one of the things too is that if maybe you can offset that conservative nature by trading larger. So I trade, let's say, 5 units, whatever that means, right? And then maybe if I'm going to use this conservative money management after the back test, I'll say, oh, okay, it's really delaying my compounding. So I'm going to trade 6 units because I can afford 6 units because I'm not updating my trade level. And so but that might violate the principles of the compounding a bit. I'm not sure. And now I just lost my train of thought. So someone.
Yeah, I think the issue with this approach is that you risk going deeper on the drawdowns, but as you take longer to update your trade level, you will also benefit from the when the moment comes and you get out of the water, because as you're trading larger, you will benefit the most with when the outlier comes. From where I see it, and I don't have a back test in front of me to say this, but my opinion is that you you you'll benefit the most from the outlier when it finally comes with this strategy you just described.
In
Yeah,
regards
and
to
another big benefit that I mentioned before that should always be taken into consideration when building these systems is doing the same thing as long as over and over. And so handling all of these trades with the same unit size and the same trade level, the same entry, the same X, the same stop loss. This is like the cornerstone of what we do. And so introducing this the need to update the trade level, we're happy, um, and under all circumstances, if you update that trade level and take into consideration you've closed out 20%, 30% profits, um, and then that's your new baseline. You always have to be willing to reduce that trade level if you run into a period of losses. But you want to make it hard to go down and not be so aggressive on going up. And I think that sort of mentality will keep you in the game. But it is, there is a big benefit to making the same bet size all the time. And then golly, I read about traders, trend followers who um, have ways of deciding they're going to they're going to trade 1 unit for the British pound this time, but then the next time they may do 2 units and then back to a half a unit, and that's just a total violation of handling each trade the same.
And what do you think about updating the trend? I have such an idea, and I have told it before, to update trade level when you have, for example, 5% drawdown. For example, half of your average drawdown, and every time when you have 5% drawdown from all-time high, maybe to update trade level in at this point. What do you think?
Yeah, this way you get the worst outcome that compounding could make for you, because if you update when you're in the suppose you can know beforehand when it's the worst moment of your drawdown. If you update on that level, the next trade that would be your savior is diluted. It comes from a smaller position, and then you don't get the benefit that that trend following does for us. That we seldomly win, but when we win big because you're winning small.
I mean not this. I mean that maybe I would write in my definition not clear. But if we have, for example, $1 million at our account under management, and after that we have another $1 million, and we have $2 million. So, and to raise our risk at a point when we are in a half of our average drawdown. So I was maybe not clear in my definition. I meant this.
Oh yeah, okay. If you could pin when the worst moment of your drawdown is, and then you increase your trade level at that moment, yeah, that would be the best. The problem is with pinning this moment, I think.
Yes, I have this idea for many years, and I did research. I like this, but because we must increase our level anyway. Anyway, when we have but maybe I'm wrong, but I like this, but not maybe worst. If we are waiting the worst of our average drawdown, maybe 10%, we can wait too long. And maybe if we have 5%, or maybe we can do so, half of trade level we update in 5 and half in 10. I like this idea. It's my own ideas. I like this.
Sorry, I had a question to the group here. Do you guys limit the number of positions that you can open with your systems based on risk level?
I don't. I mean, I have my risk budget, and I don't, I've never gotten too close to it. And once again, I was always taught that, you know, you have to do the back test, and then you're deciding how large you're going to trade, how much you're going to risk per trade, 1%, 25 basis points, and then whatever in between. And then that's going to de facto put you into how you're going to, what your maximum risk budget's going to be. You're going to sort of assume, even though I've never seen it, that you have a position on every single market, and you need to be able to do those trades. And we can, because we have leverage, and because we're kind of shooting for 15% return. Um, you have more leeway, flexibility if you're short-term trading, so you're kind of in and out all the time. But with me, I'm holding on positions for a year. But once again, it goes back to that most important principle, which is you got to set it all up so you can do the trade and not have to bypass the trade and not have to not do the trade because of overall risk concerns or the lack of capital or the lack of leverage.
Yeah, I do the same, Jerry. I do have I keep my eye on my available margin because I do have a margin threshold. So when I hit that margin threshold, which is getting up close to my available margin, I will stop taking on any new additional trades. But before I reach that threshold, it's all in with as many trades that happen within my universe. So that's because when I look at the trending nature of these markets, we do get significant degrees of positive correlation in certain crisis regimes where a lot of markets are taking off at the same time. Now, I tend to actually like to jump on board when that's occurring with my models because even though it is provided we're going in the right way, that's where you definitely start cleaning up with multiple outliers all occurring together. So I want as many of my systems active during those particular regimes. But then in other regimes which are unfavorable for my systems, my long look backs and my nature of trying to avoid that regime tends to mean that I only have very few systems employed. So, I never get close to those margin thresholds during those environments. But I hope that makes sense.
Yeah, I do the same thing. Just to keep it simple, as long as the risk budget allows it. I don't want to try and limit the trades because we want to enter into, well, when the entry conditions are there, we want to enter every single trade. So it's as long as the risk budget allows.
But
Yeah,
I'm
so I guess
saying,
that's
like,
my
I'm
question
saying,
there. If you guys could just clarify on what you mean by risk budget. So just as an example, let's say if you have 20 positions on, it represents 10% risk level to your overall account equity. I don't see it happening, but in the case that it does, and you're stopped out on all of those, that's 10% down right off the bat. Are you still at that point opening positions? Like, if you just can kind of define what you guys mean by risk budget, because I find this topic quite interesting.
Well, we could use what Niels uses, which is this portfolio heat concept. So it's a case of evaluating where your current trades are in relation to their stop, calculating that value for every single position in your portfolio, and that determines a heat value, which is the possibility that at any moment in time, everything automatically goes towards that trailing stop. So that theoretically gives you a maximum possible risk exposure that's held in your portfolio. But what I do find with my systems, because I'm using these multiple systems of different lookbacks, I do have a degree of hedging at sometimes going on where some of my system models might be trading short, some of my system models might be trading long, simply by virtue of the fact that they're targeting different trajectories of that outlier, some with small lookbacks. So when the trend starts turning, I don't have this massive loss in profit as it all moves down to that trailing stop, because some of those shorter term systems are clicking in, progressively hedging that event when the trends end. But the heat still gives me some notional picture of my total possible risk exposure. So I'm assuming that people might use that. But the one I use is my available margin, basically from my current margin to my available margin. For me, is my risk budget, if you like.
yeah. So I don't pay attention to any of that, but and so I think the thing about the risk budget is that you can always afford it. See, that's the key. I want to always be able to afford it. I might have to trade a bit smaller, and I'm I wanted to throw in this idea that we're always should be willing to have suboptimal performance and do things that, if everything goes well or normal, yes, we won't make as much money. That is definitely a salient principle, that we're not going to set everything up hoping it goes right, or even hoping that it looks like it used to look, or it's 20% worse than it used to look. So I'm willing to do anything to stay in the game. Um, but anyways, on this uh, but risk budget, like, I set mine up to where I'm going to trade 5 units. I'm going to risk 25 basis points per trade, and if everything goes against me in a typical day, I'm going to lose like 2.5%. Now, the problem with that is that, so I look at my sheet every day and it says, okay, you have on, 3 units. And so are you saying that if all 3 units had a negative day, a normal negative day, based upon the ATR, then you would lose 1.5. And I would say, well, not really, because I'm kind of basing it on the ATR when I put the trade on. So some of the trades, the ATR has doubled and tripled or quadrupled, and I'm not paying attention to it. I mean, I have another calculation that says, hey, given today, you have 3 units on today based upon ATRs at entry, and some of these trades are a year or two old. Based upon today's ATR in this market, how many units do you have on? What's your risk? And so let's say if it's 3 using original entry ATRs, then the risk today using today's ATR might be 3.5 or 4. It's not going to be too crazy because most of the markets haven't picked up volatility from entry like some of the outliers have.
Richard, I have a question for you. Have you noticed that when you hit your margin limit, that you are losing out on any opportunities? I mean, obviously that's a constraint based on whatever how you trade, but that's not being back tested, right? Or are you actually including that in your back tests?
Look, I've never actually got close to that margin threshold. It's almost like a fail-safe to say that I don't want a margin call, because if anything's going to disrupt my performance, it's going to be a margin call. So I do keep an eye on it, but I haven't actually come to that position where I've approached it. Inevitably, with the back tests, they're always better than what we tend to do. So once again, in the back test land, I've never approached it either, but it is something that when I set my trade risk exposure, I certainly am working within my margin availability. So I'm always conservatively applying a position based on my back test, which theoretically shows that I'll never get a margin call. And then fortunately, that has transpired with my live trading, where I've never yet approached that value. But it's not to say it will never happen. It might happen. And once again, the margin call is like one of these absorbing barriers. If anything's going to stop you from achieving your wealth aims, then the margin call will.
Yeah, Derek, I see where you're coming from with this, and this is kind of what I was indirectly trying to say. In my back test, I mean, I didn't account for those margin requirements. So essentially, what the system was really doing is it was entering every and all positions, which, due to the margin requirements, would at times, I imagine, be, at least for my account size, would be difficult, if not impossible. So some of those results were skewed. I haven't found a way yet to include in that. I'd have to do quite the back test to kind of include for that. But that was kind of what I was trying to get at. If X amount of positions present themselves, and 3 out of those positions you can't enter because of the fact that you're going to be hitting that margin requirement, and those 3 positions are the outliers, that's going to skew the results, at least in the back test. I haven't run into this in my live trading, but that's just something that I was kind of concerned about when performing those back tests.
But that's the point about all of this. And I also have to congratulate Richard on his outstanding podcast. But the question at the end boils down to, do we live off geometric or arithmetic returns? In other words, does compounding really mean, how do we want to do it? Because volatility acts as a drag on our portfolio. We were talking about it yesterday. I don't want to repeat the thing, but unfortunately, certain decisions need to be taken at the outset and sort of drive the decision process, investment process. And it's really impossible to optimize for all possible states of the world in every possible state of our return scenario, whether we should simply tot up all the trading profits or compound them. So it's one of those decisions that I think needs to happen in a vacuum. I completely get Oleg's and Bruno's point. If you are compounding even asymmetrically, so looking at your losses more aggressively than you look at your gains, which is what I do if anybody's interested in it, you're sacrificing some of the upside, because you're taking off a position and then the market moves back in favor and you've got less of a exposure to the upswing again. But these are unfortunately problems that span from how we do our accounting, what we consider to be success, what we're striving for. How are we getting that to that target return? Is volatility drag a problem, or is just a mathematical, a mark-to-market nuisance? What do we believe? And I think that's the question more so than, is there a perfect policy with respect to compounding? That's at least the way I look at it.
I think this has a fundamental problem with the golden rules we talked about last week. As I put it in my own version of these golden rules, the first one is do the trade. And Jerry just said these exact words. If you're avoiding any trades for any reason, you're not respecting this first golden rule. And the second issue here is one of my last golden rule in the list I exposed to you guys is one I heard from Niels. Is one phrase I heard from Niels, and that's we trade what we test and test what we trade. We have no information whatsoever on the trades beforehand. We don't know which ones are going to be the big ones, which are going to be losers. We have some statistics about them, but we don't know anything about it. And if we are hitting this margin level or risk level that avoids us from doing the trade, we don't know the trades that we are missing. We have no way. We don't have any information about these. We are relying on some random process that's selecting trades for us, and nothing. It's highly probable that your results are not going to look like your backtest if you're not doing all the trades. So you have to, I think, and that's how I do it. I go for an extreme case, and that's what would be my portfolio. What would be what would life look like if I had all the positions on, all the potential positions on? What would be my risk? Would that be tolerable? Okay, then this is a position size that I can tolerate, and then I do any trade, all the trades, one by one, as if I expect to put them all on. And if it's too high a risk level, then I reduce the position of every individual trade in order to be able to live with a highly unlikely scenario, but possible, that all the trades are on.
Perfect. Exactly. I would just add that, of course, if you went back and did a back test, you would sort of see that you probably never have them all on. My guess would be in real life and in the back test, you would find some sort of comfort to say that, well, even when I had a lot of trades on, a lot of them were profits, and they staggered in. I didn't put all the currencies on at the same time or all the commodities, and so they staggered in, and then some got out with losses. But I was never faced with putting on 5 units, roughly in a similar time period, and then all of a sudden really being faced with taking small losses, which is not going to look very small if you have to put all those trades on at the same time, because you could a lot of them could absolutely be losers. The system has 60% losers. So, and then, okay, what are you going to do though? Then you're going to not do that. You're going to say, oh, this is a crazy period. I am not going to put on all of these trades at one time, or I'm going to start putting them on. But if I start having lots of losses, I'm going to reduce my trade level. That's always the answer, which is to trade smaller. Trade smaller in periods where it looks like the risk is higher, so you can, which will allow you to continue to do all the trades. So we're just going to be slaves to doing all the trades. and doing them the same way, not picking and choosing, because I've been faced with that as well, where I'll pick and choose which ones to do, take some off, leave some on. It's just always going to be better to stay in the game, reduce your trade level, um, and continue on doing the exact same things, realizing that in my experience, whenever I've reduced my trade level, it literally has been at the worst possible time. But it only has to get bad one time, and then you could be out. And one of the things I wanted to mention with just a comment, ask Bruno, uh, given that I don't, um, the way I handle my trade level and stuff does, I would say the volatility does not drag down my performance.
Yeah, I
Yeah,
guess it goes. Sorry, cut you off there. I guess it just goes without saying. Then the size of your account matters, especially for your regular retail trade. Your capital restrictions are not letting you put on all these trades, but in the back test is you are putting on all these trades, then you're going to be running into a problem because all it takes is for you to miss one or two outliers, which could be outside of your capital restrictions, and you're not going to get those benefits of trend following. I think it's important to also make that distinction in terms of when we're talking about these benefits. For which type of trader are we talking about? For the institutional trader, the trader with deeper pockets, or your average retail trader?
Yeah, I would just trade smaller and I would trade fewer markets. I love diversification. I love making lots of money, but being able to take all the trades as they come, that is the number one. That's number one on Bruno's list, number one on my list. Be able to take all the trades. So if you can't, I posted this thing. People always ask me this question, and I don't even trade. I'm not even an expert on stocks, but there is something called fractional shares, and you can literally trade stocks and ETFs, commodity, currency, bond, ETFs, and build a portfolio. I would assume if you can buy fractional shares uh, with a lot of diversification. But I started trading 20 markets in 1984. So 20 markets, it's not so bad. You got to do the best you can do. I think you you need. This may be something that Richard would disagree on. Like I would say, and maybe I'll disagree once I hear Richard's opinion. Of course, I would say that if given an opportunity, I would trade 20 markets and just miss some outliers on the other 100 that I'm not trading versus um, kind of change my methodology to where it would be less consistent, but always trying to like get out of a bunch of losing trades and hop into something else. But I got out prematurely. I'm not following my system as much, but I'm really just trying to find these outliers. So I'm in and out a lot. Maybe I don't think I would do that. I think I would just trade the 20 markets.
Yeah, that's what I do. I trade not as many markets as Jerry. I trade much less because that's what my capital level allows me. But boy, I'd say I have to say it hurts being out of the oats trade.
You can be
quite to the point.
in oats in different ways, Bruno. Like, as everyone knows, I'm a small retail trader. So what I've done is I've said to myself, right, I can't get the level of diversification that I want in the futures space. So are there any other products available that gives me that diversification potential? So yes, there are. In my particular world, there are these things called CFDs that offer, up to 500 to 1 leverage. So wow, bang, I've got this significant leverage opportunity. And then I've got the ability to trade microlots. So I can get exposure to the underlying futures using CFDs. That's why I'm in my oats trade at the moment, but it's with a CFD derivative. So where I personally think that diversification is essential for this hunt for outliers. So where I say is, if I can only obtain 20 markets with my limited capital in the futures market, um, is there another way to obtain exposure to 300 markets through another product? And yes, there is with CFDs. But of course, there is the cost drag associated with the higher costs of the market makers in these products. But because I'm trading, the medium term and long term, many trades 2 to 3 years. There are holding costs associated with that, and there's a slippage associated with. There's the transaction costs, the brokerage costs, but these costs, in terms of this outlier move that I'm trying to capture, are quite immaterial. Yes, they're higher, but in the notion of catching these outliers through this extensive diversification, the trade-off, to me, it's an open misere. There's no, get into these, if you're a small retail trader, get the trading wheels on, trade these available markets that offer this possible opportunity to lift your capital to a point where, once you've built your capital base to a point where you can get extensive diversification in the more traditional future space, then you move over into the traditional future space. So that's sort of the way I've approached this little riddle.
Yeah,
I would mention the micro contracts that are now available on many commodities and financials futures. Sometimes the size of the contract bites you. It's too large for if you're not that big. And now the micro contracts allow you to, they help.
By the way,
back to your question on volatility drag, which doesn't matter to you. I wholeheartedly agree with you, and perhaps this surprises everybody and says, well, how can I agree with the fact that volatility does not act as a drag in your case? And I stress, in your case. And the answer is because you are looking at your trades as a collection of individual positions. So you're optimizing, you said it many times again, you optimize your trade for what it is. One entry, one exit, and that's it. And a stop, of course. So, if your trade is above the stop, you should really be in. And it can be more or less volatile. You don't care. It's not your problem, because you're getting to your target, which is either I'm going to get stopped out. Eventually, I'm going to get stopped out. But either I'm going to get stopped out because I lose, or I'm going to hit an outlier and make hundreds of ATRs. And that's it. That's my strategy. In the other world where I live, where I think Derek lives, there's a bit more. We have a little bit more variables, and we have this unit called the portfolio. So trades actually act a little bit in respect of one another once they are in the same container. So sometimes oil may be selling off and gold may be rocketing higher. Some other times they're both selling off at the same time. So this is what I call the volatility drag. This is and the question is this just mark-to-market noise, or is this something that we should be paying attention to? And here's my very personal idea: it's both. Sometimes you shouldn't really care. At other times, you should really take action. So, that's why I keep talking about, and I don't want to repeat myself, you need to have a model, you need to have some sort of ways of discerning and dissecting, okay, this is just noise, or, this is the market telling me something. So hopefully that answered the questions. But in your case, I firmly believe that you shouldn't really care about this volatility drag, because it's not something that you even monitor.
That's right. Yes, I just wanted to make sure I understood. Yeah, exactly. However, I will, maybe it's just semantics, but I care about the numerator, like losing. I had a big profit, now it's a smaller profit. And I would like say, wow, I have a lot of open profit. Maybe I'll take something off because I like the profit, but not because of the drawdown piece. Maybe it's the same thing, but I'm not.
Yeah, I think it's the same thing. You make pardon the definition, I can't think of a better word, a discretionary decision to act when your system tells you never act, because, is one entry, one exit, and one stop.
I'm not saying I do that, but I would do it but not because of the drawdown piece. Like, for instance, if I had a 500 ATR profit, I would say to myself, in the context of the 500 ATR profit, I probably am okay with booking 300 ATRs or 350. And then someone would say, dude, you're going to lose 150 ATRs? I'm like, oh yeah. I mean, I don't care about that part, that drawdown piece, but I definitely care about the 350 that I'm going to book. And then once again, I think you affirmed this the other day, which I'm always looking for affirmation. So maybe maybe it was someone else, but I also made the point after saying something like that, that I'm pretty sure that you would make more money not doing a discretionary move like that, or building that rule into your system, because you don't have enough sample size really to. It's just a guesswork if it's going to how much you're willing to give back on profit. But I think I would say that regardless, you probably make more money. I'm pretty sure not doing something like that.
I once again agree with you. The problem is path dependency. We talked about using leveraged instruments, which obviously stresses the fact that it's not so much getting there, but it's how you get there that makes that becomes relevant. So at times you might be forced out of your position. You have this wonderful other rule, which is trade smaller, trade smaller, trade smaller. So again, you keep coming up solving the problem that I think, well, I certainly am struggling with, and I think Derek is as well. But the kind of the Europeans, for lack of better words, are struggling with, which is how do I optimally behave? And again, you seem to have, and it makes sense, a sort of a view that simpler is better, but definitely, I mean, you are touching on all those points. I mean, do you make money? Does the system tell you that you would always make more money by not, deviating from the rules? And the answer is yes. I mean, we set the golden rules last week. I keep breaking them, and therefore I am, making less. I'm achieving my terminal wealth will always be lower than yours, but I know that because I try to sort of feel better during the journey. Because for me, at least psychologically, and maybe for other business reasons, it's important to take that into account and make it more explicit. So I have to sort of settle for less in terms of total, terminal return. The point is, I don't know when the game ends, right? At least this is my view. So I have to sort of transform it from a continuous game into a string of discrete games that last for about a day, a week, or a month. And by this, I'm violating number one rule, which is let your profits run. I know that.
It's interesting. I hear about Jerry's early days with the turtle traders, and um, I hear about Rich Dennis and his demand that you've got to simply do the rules. And in that position, Bruno, where you'd be sitting as a a trader with your training wheels on, you'd be saying, oh, there's so much profit there, I just want to take some of it. And then there'd be this sort of Richard Dennis sitting behind you with a very large ruler about to thud down and you saying, play the goddamn rules.
I think it's 5 minutes into that program, by the way.
I will give my opinion, I think, because my name has come up a few times, and I 100% believed that there's a distinction between considering your portfolio a portfolio of return streams versus your portfolio is built from Legos of trades. There is a significant difference on just thinking I have X units on these markets and the sum of these units equals a portfolio versus looking at these are the return streams of my systems applied to these markets, and that is my portfolio. And I do believe that path dependency matters. Going back to the 80s, hedge funds were young, type of clients that you would get were different. Now, with the rise and potentially fall or reshuffling, cycling of these European CTAs that comes up a lot, it has changed the game. no one that I know or whatever is willing to take 20, 30, 40% drawdown. That's just it's not happening. At 20%, I can expect significant redemptions. Maybe some will stay. Maybe some of the people who've been with me for a while, or people who believe in the system, or it's providing diversification, or whatever narrative I can pitch out to keep them around. And I think that's a difference of the game. When we talk about missing trades and not getting the outliers and portfolio composition, it does come down to a path dependency, and this kind of goes back to before the conversation talking about when you're missing trades, because you don't know which trades are going to be the trend. It's path dependent in whatever random sample of trades you were able to put on in that portfolio of trades, whether or not you actually got the trending trade inside your portfolio, or you missed it because you didn't have enough money to put it in, and then you actually lose a significant portion of your returns for the year, because we know that our portfolios benefit from a small proportion of trades. It will be random, and that randomization in your portfolio is bad. And that also comes to this other side of the equation on how you're building up your portfolio and managing the path risk. I'm not saying, I mean, this is definitely from a business point of view unacceptable for the firm I work at and for the clients that we have. Potentially, if I was working in a different environment or had different clients, it would be different. Or if I had a different track record or life was different. But as an emerging manager now, I have not found a way to repitch what I would consider a Jerry or a Richard style strategy and have it be acceptable.
Well, this is. Oh, sorry.
Go ahead.
No, sorry, to cut you off there. Let you finish. Go ahead.
I mean, I'm just rambling, but it does come with trade-offs, right? Like, I think we all understand clearly both sides of this coin. Very clearly, some people can be on one side and some people can be on the other side. I don't think that it's necessarily wrong, and that's where I get caught up a lot of these conversations at the Clubhouse, where I'm taking like the devil's advocate position, because what we are exploiting is the same. It's like there's many ways to skin a cat. There's many return streams you can get if you know you're targeting outliers. How you craft that as a portfolio manager, as a fund manager, you're delivering a product to the client. It's not about you. It's not about what you necessarily would like to do. It's you are serving these clients. You need to do your fiduciary duty and to provide them the performance that they want in their portfolio. Maybe that just means how do I put it nicely? A returns prostitute. But I'm happy to deliver what clients want in order to make a business.
Yeah, that's the thing that I'm glad you put that. Well, Derek, I mean, just to kind of streamline it into the individual investor, like that's the thing that I've kind of struggled with when it comes to that, because here I am running back tests and I'm trying to capture these outliers, which is an amazing concept, and I completely agree with it. Running it across all possible instruments. I'm not including the fact that there's going to be margin requirements, and this looks great. There's obviously drawdown, but it looks great. But then when it comes to my real live trading, based on my account size, I'm actually limiting that universe to, let's say, 20 out of the 80 markets that I've traded. And essentially, the sample size that I'm taking means that there will be times that I miss outliers, which is great. And that kind of, well, no, it's not great, but I'm going to miss those outliers, which is problematic. So I've kind of struggled with that psychologically to say, am I deluding myself? And this is a question to the group in terms of trading 20 markets when I don't know if any of those 20 will have those outliers. They may or they may not. Whereas I'm basing that on a back test that says, no, you should take all trades across all the possible markets. That's kind of where I was running into some psychological difficulties to try to put that all together.
Boris, I have a similar problem, but different. Because of the legal structure and PPMs that this trend following portfolio sits in, I have a notional limit. So I don't have infinite leverage, or at least according to AHL, they have like 10,000 x AUM leverage. I don't have that. So I do have a total notional constraint, not a leverage constraint, which really sucks. Don't do this type of stuff in Europe. It's just a pain. But the crafting of the portfolio and back testing what you test is the important bit here. And my advice to you, Boris, would be don't back test all the markets. Back test what you're going to trade. And if you know you're going to trade a restricted universe, back test that restricted universe and take a lot more care in developing that universe so that you have opportunities to hit all of the different sectors. You're not going to be able to trade, all the different types of energies, maybe, or 5 different kinds of wheats. You get 1 or 2. You trim it down, and yes, you will be missing outliers that are not in your universe. I mean, I have 90 plus markets. I'm slightly less than 100 at this point, but there are definitely markets that I can't trade, and I don't care about those. But I have crafted what I can trade as best as I can, and if I even had to reduce that to 50 or 30 or 15, I would. Okay, maybe 15 is a little bit low, but I would say like 15 to 20 is probably where I'd say is like the barrier line that would allow you to have, say, 2 of most major markets, and then you can fill in the gaps, with the things that are kind of like one-off, like your Bitcoin or whatever, or your palm oil, or your Asian rubber, or some kind of like one-offs that don't have multiples in different sectors. Build it up from there, and then you'll know if there are major sector-based trends you're in. If you get the decorrelated trades where like Brent is moving out of crude and you don't have the Brent, for example, or like you have Chinese coal but you don't have, say, like Newcastle coal or something, that's okay. But in general, the major moves that are pushing these types of things, maybe that trend will migrate to what you have in your portfolio at some different time. Maybe not, but don't get overconfidence in your back test when you have opportunities you won't have in real life. I think that is you're deluding yourself.
Yeah, absolutely. Those are great points. And I actually did. So what I did is I took a back test, or I took a basket of instruments that I can and I do trade. And I did test it, and performance suffered. And the reason why I think the performance suffered, and I think we can all agree to this, is that optimally you have to be trading all of the available instruments, in the sense that you want to get that diversification as much as possible. When you do not, then performance does suffer. Now, whether that lack of performance is acceptable to a person, I guess that's individual. But there was that issue that I did run into, that it wasn't getting the returns that I thought it would happen. And of course, not deluding myself into thinking that running a back test across all instruments, without any capital requirements or restrictions or margin requirements, those are the results that I'd be getting. That was number one. Number two, I think I do, and I agree with Richard as well in terms of CFDs. I think they're fantastic. I think they're only available for certain countries, I believe. I'm not sure if they're available in the States, but in Canada they are here, and they are great. The cost, I wasn't able to factor that in my back test, which kind of concerns me. Anytime I can't include anything in a back test that could potentially have, an impact to the bottom line. So there was also that I was running into, but maybe there is a way I could figure that out. It would just require a whole lot of digging through data to see, what the costs were at each specific year and as far back as you could possibly go. But no, those are some great points, Derek, and that's kind of what I struggled with for a while, in terms of the limiting those outliers by default, because you can't catch all the markets that your back test is, or that you'd like to.
You brought up a good point on, I'll say, optimizing markets or strategies based on cost. I think this is something Robert Carver has talked about on the podcast before. I don't have his formula offhand, but it is a really important concept, because if you have a limited portfolio, you should be optimizing. If like you have 2 different crudes, you should pick the one that's cheaper. And there also may be markets where like faster trading strategies aren't as viable because the costs are super high. So, you could look at, whatever the potential return is of your strategy, back tested on that, divided by however many costs, and just like kind of look at the percent ratio per year that you're spending on this versus this strategy on this market versus the other markets. And then we'll give you like a flat baseline to find out which markets are actually like way too expensive for you, because or specifically strategies that might be overturning specific like expensive markets. And I think that is even more important in the small portfolio because that expensive market becomes a larger percentage of your total portfolio allocation. So potentially, if this market has a higher margin requirement and you could have fit into smaller markets or to less expensive or less margin intensive markets, that may be a benefit.
So of course, what Derek just said is something that it's very relevant. And the biggest point about costs is that in every business, entrepreneurs have certain certainty about costs, around costs. You know how much you're going to spend for that thing that you're about to purchase. You don't have to estimate. You don't have to backtest. You don't have to build models for it. You just simply your model is is the addition. You keep adding up, totting up all the costs. So it's really, really, really important to do that because it gives you an idea of how much you're going to spend to trade your strategy. And as Derek said, if you can relate that to your Sharpe ratio, you're going to have an immediate risk-adjusted expression of that cost, which acts as a drag to your return. And that's very important and very easy to do. Obviously, a bit laborious in terms of setting up the backtest, but it's definitely worth the hassle.
Perhaps you can find some help in Rob's blog. I think he has a lot of code in Python down there.
Actually, Boris, if you're used to trading CFDs, we actually adopt a process where it's a fully sort of algorithmic workflow process where in our determination of the universe that we're ultimately trading, initially we start with the infinite possibilities of our broker's capability. So we might have multiple brokers we consider trading. We'll be undertaking tests with long-range data over all of their available data. So what that does then is it defines return streams for each of these possible markets, and then we effectively what we're doing there is we're doing a robustness check to basically try and identify common variables which are applicable across this very broad basket of markets that catch outliers. Then what happens is we say, well, that's of course the theoretical basis of what we're trying to achieve. Now let's start backing in some of the practical applications of actually trading this basket. So that's when we start looking at our capital allowances, how much we've got, how do we compile return streams together that maximize our potential to diversify within this set of possible states of return streams. And then we back in all of our sort of cost assumptions of real trading, slippages, all of these things conservatively applied to then compile a practically applicable portfolio that actually we then put into a demo trading environment for about 6 months where we just ensure that our strategies are performing in accordance with the thresholds that our backtesters told us we can trade with. Once that's past that demo or incubation phase, we then put them into the live trading account with a degree of confidence that we've got the practical implications already embedded into the practical costs embedded into these solutions. We've got this possible potential optimal portfolio by virtue of the most efficient return streams that compile to produce the optimal risk-adjusted returns, and that's how we trade it going forward. So that's sort of like that's a process we adopt within the CFD space. It certainly ensures that we are definitely considering front of mind the practical limitations of actually trading these things that we test within the backtest environment.
Yeah, that's awesome. Thanks for that, Richard. I mean, this is why this group is so important because, most of the time I spend my day thinking about how can I potentially be deluding myself. When I first initially started running these back tests across all these instruments, I was ecstatic. I mean, the drawdowns were there, but the results were great. I finally figured, this is something I can tolerate. And that was based on the golden rule, which was take all the trades. But then I had to revise that rule to say take all the trades that I can personally take in terms of confinements in my account and all of that stuff. And the results suffered. It's still tolerable for me, but it did suffer. So I just wanted to kind of throw that to the group there to see how folks are handling with that. I know we're obviously all have different accounts and different requirements or different careers in terms of what we can and cannot trade, but just wanted to throw that question out to the group because I think the whole purpose is to diversify, to take all the possible trades that you can, to cast that net wide and far so you can catch these outliers. And unfortunately, if you can't do that for whatever reason that may be, your results do suffer. And my whole point was just not to rely entirely on that back test, which I think is what everybody knows, but just kind of had to reaffirm for myself.
Yeah,
I think that there,
interestingly, sorry, Jerry, you go.
I think there's different ways of suffering, and I'm not going to repeat everything I've said, but um, suffering because you only trade 20 markets. I think that's preferable than suffering because your 20 markets didn't have an outlier that you see someone else had. So, but anyways, I wanted to comment very quickly on this, on what Derek said, and I agree with everything Derek said. Basically, I think it's kind of funny that because I'm in my 60s, so I can think that if people don't want to give me money, I can still think that's pretty funny. And I wish I had done done been more compromising and created a fund that was more palatable to investors. And I had a lot of AUM, and I was collecting management fees and incentive fees, and I could just trade my own way, a different way, the way I trade now on the side. The Jerry fund is for Jerry and people like him, but I definitely am jealous, and I definitely think that um, it's you have to take as much trend following as these clients can accept, as much classical as they can accept, and then do something, to make it so you can build this business. And so there's I definitely agree with that. Fall targeting every single day? No. Selling it as it's superior to one entry, one exit, and a stop loss? No. I mean, that's not true. It's not honest. It's ridiculous. But you don't have to be so truthful. You don't have to be so transparent. It has merit, and I do think though that um, a 20 to 40% drawdown. It's really not the way I would look at the problem with this strategy. It's, can people accept a point 0.5 sharp? And then if they can accept the point 0.5 sharp, then maybe you can, you tone it down to where you're trying to make 10% in this environment. 10% is a hell of a return. Um, yeah, so I think it's not, you could always tweak your leverage and your expectation of the profit. And then, of course, with the trend following, what's so important, um, I just don't think I can say 40% drawdown, 20. No, it's, well, how did you do over the last 12 months? What environment have you been in? What's your rate of return what's your trailing 12-month rate of return when you've had this drawdown? Still, the absolute number, even if it's coming from open trade equity, even if you're still up 20% for the year, these are all just components of what's in clients' brains, and your goal to walk that fine line of creating an honest product, good product that's going to stand the test of time, and yet one that takes in consideration the feelings and the realities of your clients in the real world. But this other thing that Derek mentioned, I really wanted to talk about. This is a very good topic. I love topics where I have a very different opinion of this. And I wanted to get, from a theoretical point of view, I would, if I could only trade 20 markets, I would not back test that restricted universe to determine my systems. I would use every market I could possibly find and then say, okay, this is giving me more evidence. I'm not going to trade bean oil and meal, but I'm going to include bean oil and meal in my back test because this is more knowledge of what works well in trend following. I'm going to trade my 20 markets all the same. They're all the same thing. They can have the same expectation. I'm going to choose, um, but I want more information. And so just because I'm not trading the bean oil and the meal doesn't mean I'm not going to add in all of those markets that I'm not trading in order to determine the best parameters.
So Jerry, just before I guess Derek gets into that, so from a theoretical perspective, if you're trying to tease out whether trend following works and what the optimal parameters are, then yes, that would make sense. But if you're bringing this to whether you're going to make money, then I see Derek's approach has a lot of merit, because yes, you've proven that okay, trend following does work. That theoretically, it's a great concept. But if you can't apply that to yourself at the individual level, does it really matter what you can prove theoretically if we're in the business of making money? So sorry, Derek, I know you probably wanted to jump in, but
It's fine, Boris. I will say I have found some of what Jerry likes, which is like that acknowledgement of the idea, because that is exactly what I'm doing. I am my returns are more than 60% based on trend following, and that is because it's the most that the clients I have can handle, and I do put in other strategies and other overlays, whatever, to make it nice and special. But the pure classic stuff is the vast majority of what I do. I don't know if that's like putting my alpha out there now. People will I don't think it matters if they take it. We've had this discussion before. But on the theoretical side, and to Boris's point, it is important to backtest all of the market's data that you have available, and then do another test on just what you can do, because you're trying to find out two different conclusions. The conclusion you get by creating the ensemble of all of the different markets shows the robustness of the edge, because you've increased your sample size, which is like the number one thing. You can also do, because you have more data, you can do a lot more optimization things, and it'll be more robust. But to Boris's point, in the end, you will have to do that test to find out like what's your expected return, what's your expected drawdown, given the universe you've selected. And I personally will agree with Jerry's point on just backtesting the subset. Like if you add one new market to your mix, you don't necessarily have to run a backtest on that. Or in my case that I have done before, I know these strategies work on, say, US markets. If I'm adding a Chinese market or an Indonesian market or whatever, and it's short on data, I can be pretty confident that and I can execute this thing on this new market. It's because I leverage the pooled aspect. I know based on this extremely large, diverse sample size that adding one more market, which might only be, say, you back test on 100 markets, is only actually like 1% of new data, so to say. It's not going to change your overall expectation of what that's going to do. So then, that's it, I guess.
I think this comes to the usual divide we have between us. If you're evaluating your backtests trade by trade, or on a time dimension, I see the merit of Derek's suggestion if you're evaluating on a time dimension, because then you need to see for yourself what's the correlation between the return streams, what's the risk you're incurring, to risk as in a volatility sense. But I tend to default to Jerry's point, and to Jerry's side, because I do view the portfolio construction and the system construction on a trade by trade basis, and on this on this interpretation of markets, in this way of thinking, you need sample size. You need the most markets you can backtest, because you assume beforehand that you don't know anything about the next trade, and you don't you can't pin out if the behavior of of future, I don't know, wheat is going to be similar to the behavior of past wheat. So you get all the markets in your backtest and hope that the full sample of trades is the best informative piece of backtest you can get, and then you can find what the best parameters are. Try to and finally, you once you have all these parameters, you apply to the limited markets you pretend to trade, and take a look at what the equity curve would look like, and I don't know, do all the exercises past the main part of the backtest. The meat of the backtest is done. I heard from Jerry. I learned this from the Top Traders Unplugged, and I don't know. I don't want to make their words as if they were my own, but I get the least amount of information from the backtest I can get, and this is the trade stats. I see what's the proportion of winning trades, what's the average win in relation to the average loss, and that's informative enough for me to decide my parameters.
Yes, that's very good. There's no information in data from one market. There's no, I think this, when I was able to finally log on earlier, I was in the midst, I think, of a conversation that, I don't think that there's no such thing as China markets, Asia markets, crypto markets. This is a fundamental principle of trend following, which is the sample size. And the only way we can get the sample size is to ignore the idea that these are all different markets and say to ourselves that they're not. They're the same. If we had a million markets in a million years, we would see this more clearly, that all the markets, not only we assumed they had the same expectation per trade, they would probably look like that. Actually, they would have the same expectation in real life. But I think this is just a fundamental principle that it all falls apart. Our whole idea crumbles into nothing if we don't treat the markets, trade them all the same, treat them the same. They are the same. There is no difference. There is no information worthwhile to be gotten out of subsets of any of the markets. And whenever I say this, I often think like, oh, wait a second. Um, you have to put the caveat in there that if you took all of your 50 commodities and 50 currencies and 25 bonds, you couldn't add 5,000 stocks to it. You probably wouldn't want to do that. So you got to use some, I hate to say common sense, but something like that to sort of, not overwhelm the data with the wash out all of the other markets, personalities, um, with the stocks. But I think this is a fundamental principle that what we do doesn't work. There's nothing to believe in if we don't treat all the markets the same way.
Yeah, I guess what I'm struggling to understand is the following. So if we want to prove that trend following works, right, and we use these golden rules and we do a back test on all the possible markets, and it actually comes out that it does work, that's fantastic, and that's we can check off that one piece. But the second piece to the individual retail trader is, will this work for me, right? So you've proven the theoretical concept of, chasing outliers or hunting for outliers and trend following with the diversification parameters, all that works. But if you can't bring it to your own trading, right, for whatever reasons, whether it's capital restrictions or, margin requirements or whatever the case may be, then I think you're doing yourself a disservice by not backtesting on that subset of the markets that you personally can trade and seeing how that will turn out. Because it's great that the theoretical concept makes sense, but if you can't do it, then it doesn't make sense. And you only have two options really. You either save enough money that where you can do it, or perhaps you invest with a manager that is able to do that. That's just what I'm seeing. And what kind of triggered that is when I was backtesting some mean reversion systems, and they look fantastic until you realize that, wait a minute, I have to have a way to sort of sort some of these markets out, based on some sort of momentum, measurement or whatever the case may be. And I might only have, 10 trades that my system allows me to put on. That's the complete opposite of what you want to do with trend following. You want to put on as many possible trades in as many possible markets as you can. When you do that, it works fantastic. It's very robust. But once you try putting it into certain segments or buckets based on your capital restrictions, it tends to suffer. I'm not saying that it tends to suffer to the point where you shouldn't trade, because Jerry, I think you made an excellent point in terms of suffering. Personally, I'd rather suffer with just trading 20 markets, trend following style, than not trading them at all. But I think it's just important, to kind of mention that to certain subset of traders that are not able to have that diversification. And they're looking at these back tests and saying, wow, this concept is amazing and it works. But when they're translating into their own accounts, they're not seeing those results.
Well, I get that, but I think, as Bruno said, you're taking too much away from the back test, and it's not. You're not getting that information that you think you're getting. The best parameters to use for corn is not what's worked best for corn. It's what's worked best for the group going forward. So you think when you get done doing this back test that now you know what to expect. I think those were your words. You don't. No, you don't know what to expect. It's going to be much different. You will be lucky and thankful if the average win, the average loss, the win percentage is similar, but it's going to be much different. I told a story about how I had a revolt in my company because I chose some of these stocks to trade in our portfolio, and they did the back test, and the research people were like, these stocks have not done well in the past. This was Tesla, Moderna, and stocks like that. So the past performance of those markets, those 20 markets, is not indicative of what's going to occur in the future. So that's our point. The best idea for the future is the whole group. Now, I think there's a little bit of issue here that I can't really reconcile, and I need help from Richard probably reconciling this. But prior to talking to Richard, I was always saying to people, well, if you only trade 20 markets, your expectation per trade is the same, right? Over a long period of time, you'll make the same amount of money. You just don't have as many, it'll be more volatile, right? Because if I trade 200 markets, my expectation per trade is the same for each trade, but my volatility would be lower than if I only traded 20. So you're going to make the same amount of money as the rest of us. And then sometimes your volatility may be less, but over the long period, it's probably going to be higher. But then Richard told me this idea. Well, it's really not a question of volatility that we trade all these markets. It's really seeking more of these outliers. So maybe that's a little bit contradictory there, but I really do believe that 20 pretty diverse markets will be just fine. You don't have to participate in every outlier. No one participates in every outlier that's out there.
Yeah, no, that's reassuring. And just before Richard answers that as well, so just to clarify one thing about the whole 20 markets. I mean, I'm not saying that you're choosing those 20 markets and you're looking at what the back test is showing you in terms of that. That's what you're hoping to expect. I think 100% I agree with you there, Jerry. That that would be a foolish thing to do. What I'm saying is just that the reason why you're breaking that into a segment is because you have no choice. right? You personally, personally as a retail trader, you do not have a choice, for example, of trading a specific market that's outside of your capital, base. So because of that, you have to restrict those markets. So I'm not saying that you're looking at that performance of those 20 markets and saying, okay, this is the ones that I've chosen. This is the performance that I can expect. All I'm saying is that you can't backtest, well, you can to prove the theoretical concept, but for the practical side, you can't backtest every single market if you as a retail trader can only trade 20 of those markets or 10 of those markets. I can see the point that Derek was trying to make is if you backtest for those 10 markets, then it's not the performance so much that you're looking at, it's just what is it going to look like to you. Now, I completely agree. And maybe, Richard, you can explain that whole expectancy concept in terms of if you trade 20 markets, you should see the same performance as if you were trading 200 markets, because I was under the impression that it's the outliers that count. And if you do miss those outliers, that you wouldn't hit that level of expectancy. So maybe you could just clarify that. But Jerry, that is an excellent point at the end that the 20 trades or the 20 markets are better than no markets. So I'll definitely take that. But maybe Richard, if you could just kind of explain that further to me.
Yeah, look, over the long term, each individual market tends to produce a similar overall result, but that's not talking in terms of diversification. When you diversify, you achieve two objectives. One is you do smooth the returns of the global portfolio, and that's because you're using these correlation offsets or these drawdown offsets. So naturally, as you increase your diversification, provided you're diversifying in relatively uncorrelated markets, you do get this smoothing of the drawdown exposure of the global portfolio. And also, as you increase your diversification, you're increasing the frequency of the number of outliers that are expressed in that global portfolio equity curve. So I personally believe that it is essential to build diversification. And I personally think that 20 markets does not give you the level of bang for buck. And in our retail world, I'm therefore looking for options or products that allow me to get that benefit of that enhanced diversification with leverage and that non-linearity. That's why under CFDs, I can trade 300 markets as opposed to, say, 20 markets within your future space. So that clears up that. The second thing is I totally agree with Jerry about the back test of a single market produces one possible historic path. Now, when we apply the first thing you've got to do is say, well, what type of model are we going to be applying to extract our edge from the market? And let's assume we say trend following. Then the first thing we do is we design our systems to our trend following systems to apply these golden rules that extract that edge that we know those golden rules do. And then we're basically searching for a solution that basically makes sure that in setting our initial stops and our trailing stops, we are bound by the history that is presented by data to determine what is the placement of those initial stops and trailing stops to get best bang for buck and ensure that we don't get too many whipsaws and ensure that with our open profit potential, we can catch these outliers. So we do need to use data there, but this is where I totally agree with Jerry. Let's say we backtest corn over the last 50 years. That is one possible history. So once we've got those trend following models, we normalize that across the entire universe that we want to test on. And let's say we're testing across a possible universe. So in our testing process, we say the first step is let's get rid of any notions of practical limitations of what we can actually trade. Let's use all of these 100 different markets, normalize our models so that each separate market provides an alternate history for corn. So let's assume it's all the same data, it's all corn data, but now we've got a sample size that's 100 times the sample size of our 30-year history of corn, and let's apply our trend following model to determine what is the optimal initial stop, what is the optimal trailing stop. We let profits run. There's our model. So that's therefore increasing the sample size under testing to make our hypothesis much more valid in determining what is the model we apply to any possible market. Then what we've got to say is, right, recognizing that we've now got our robust model that has been tested across 100 different possible histories, now let's look at the practical limitations of what we can actually trade. And that's where you do, once again, have to use the history. But this is where you use the real history of all of those markets, as much as you can get, 30 years or whatever. And then you compile a portfolio to develop the optimal risk-adjusted performance return. So what that's doing, it's then saying from all of those alternative histories and how those models have been applied to it, here are the returns for each of those return streams, and here are the maximum drawdowns for each of those return streams. Let's compile a portfolio that produces the optimal risk-adjusted return at the portfolio level to meet our capital limitations. So then we might say, well, now we've got to back down to, say, 20 markets. Of that grouping, what is the best composite that we can achieve? So by using a risk-adjusted return, which is, say, the MAR ratio, which is the compound annual growth rate divided by the maximum drawdown, we're not compromising the outliers. We might find that certain markets have outliers at the certain same times. They're coincidental. But that doesn't compromise our CAGR. But what is really important is the adverse exposure, the adverse returns, the maximum drawdown exposure. So sitting below that equity curve is the adverse returns. We want to make sure that's as non-correlated as possible. So at the global portfolio level with 20 available markets, what is the ideal scenario based on the history that is presented in that track record? What do we trade? Now, what I find is that normally if you approach it from, well, I want to obtain exposure across asset classes in commodities, forex, metals, all of these things. So you make an assumption that these markets are uncorrelated. What I find when I run the data, these extensive data tests of my backtesting engines to derive the practical solution of how many markets to trade, it naturally falls on an uncorrelated suite of markets that typically gives representation across all of these asset classes. So that sort of does a big tick to that hypothesis that it's best to trade, with limited capital, spread your exposure across different asset classes. And I find the data actually validates that. So that's a process I'd use, and I hope that answers some of that.
Yeah, I see we're reaching 2 hours here, so I'll try to be really quick. From where I see it is, we don't know what the next trades will be. All we have is this backtest that has this trade statistics. So what we do know is that we need a number of trades for one outlier to be among them. Say it's 1,000 trades. So you can either deploy capital or deploy time. What you need is these 1,000 trades. If they're going to manifest themselves in the 20 markets you trade in 10 years, well, then you're deploying time. But if you're able to deploy capital and trade 200 markets, then it will take 1 year for this trade to show up.
I guess Boris has a point, I think, and the point is, let's see if I can actually verbalize it. He's saying this is big sense, but what's the point of constructing a portfolio that has in there a market that I cannot trade? So I think Richard explained it very well, and it's sort of it's a bit of a repeat of what Derek said. At some point, though, if you are limited in capital, you need to make sure that you are looking at your return expectations, which is different from I very much agree with everything that was said. High-level parameters of the system can be set with as much data as one can get, including markets that you don't plan to trade. But this position size in certain things, I think, have to take into account your traded instrument sets, because it's not so much about risk missing an outlier. It's just that, let's say that you couldn't trade, I don't know, natural gas, but you could trade European, UK European natural gas as opposed to American. If you did that and realize a slightly different path than what you expected, that cost in terms of mark to market or whatever, hitting a stop or something like that, penalizes you a lot more than saying, well, I should have traded, I don't know, Bitcoin in the meantime because Bitcoin went to the moon, but you never intended to trade Bitcoin. You simply weren't allowed to trade an instrument that delivered because of constraints of your account size. So I think, yes, Boris, you have to make exact provisions, and you've seen it in your back tests. And to do that, you really have to see and to trade instruments that deliver your expected returns and move around as much as possible without being without delivering excess volatility. So how do you do that? And then again, it opens up to how much you can trust your back tests. And again, I subscribe to everything that was said. So you can't trust the back test very much. So that drives you back to one lower level, which is cost. And which instruments are expensive or cheap to trade drives also this asset allocation decision. So yes, you have to take into account all the instruments, the tradable instruments, and the best instruments you can trade versus the cost of trading those instruments as well. So it's a multifaceted process.
Yeah, awesome, Bruno. You summarized in, I guess, in the last 3 minutes what I've been trying to, ask for the last hour. That's exactly it. That's exactly what I'm saying. So nothing further to add. Although Bruno's prior comment about the concept of time, I actually wrote that down because that's a very interesting concept. I'll have to think about that one and maybe next week bring it up. But that's something I haven't considered, and it's actually an interesting point that if you're can only trade, let's say 20 markets as an example, you might have to sit on it for a lot longer and stay solvent for a lot longer, but that outlier will eventually come, I guess, within 10 years in your example there. That's an interesting concept. I'll take the weekend to think about it, but no, thanks, Bruno, for that as well.
I want to add here that we must use common sense here in choosing these markets. And of course, we don't know how correlation can change, but we must find markets, choose markets, which are uncorrelated as much as possible. So very good in commodities markets, they are very much uncorrelated. So maybe soybean and maybe oil, Brent, and so on and so forth. So if we do so, we must choose markets. It's my own opinion. I understand that correlation can be changed, but there is no choice here. As much as possible, uncorrelated return streams. I think it's the key to success here.
Thank you, Oleg. And if I could just put one other thought in your head we could discuss next week, and that would be, so I came up with this idea, and it was maybe that it would be better, getting back to this proverbial 20 market portfolio, to randomly select 20 markets and then run the back test on those. So do this numerous times where the computer just randomly selects the 20 markets, does the big back test, and I think that would probably give you a better indication of what it's going to be like to trade 20 markets versus 200. Just something I thought of just a second ago. But anyways, hold those thoughts and write it down, and we a lot to discuss and agree and disagree on. But everybody have a good weekend. It's been fun, and see you next week at 9 a.m. Thursday for Derek, 9 a.m. Friday for Trend Following Trading Club. Thanks, everyone.
Awesome. Thanks, Jerry.
Thank you,
Thanks.
everyone.
Thanks, Jerry. Bye,
Thank
everyone.
you.
Bye.
Thanks, everyone. Bye.
Thanks, everyone. Bye.